Welcome to your deep dive. Today, we're going to be tackling trading systems.
Oh, yeah.
It's one of those topics that can seem really alluring,
Yeah.
but also kind of intimidating at the same time.
Right.
And luckily, you've given us some really fantastic articles and research to kind of wade through.
Yeah.
So Expert Speaker and I are ready to help guide you through it all.
Absolutely.
From how to analyze market trends to potentially developing a system that could really help you build a killer trading portfolio.
You know, there's definitely a certain mystique around systematic trading.
Right.
I think it's not just about the profits, but also the intellectual puzzle of trying to find order in what can seem like random market movements.
That's totally what grabbed my attention in the book Trading System by Emilio Tomasini and Urban Jekyll.
Great book.
They really emphasize the idea that it's about taking emotion out of the equation.
Right.
But I have to admit, when I saw black swan events mentioned in some of the research, it kind of made me think, how do you build a system that can handle something that's totally unexpected?
That's a great question, and I think one that every systematic trader really grapples with.
Yeah.
You know, it's important to remember that no system is going to be able to predict everything.
Right?
So instead of trying to foresee every possible scenario, I think the focus should be more on creating a system that can adapt and manage risk, even when faced with those black swan events.
Okay, that makes a lot of sense.
Yeah.
So to kind of set the stage for our listener, let's start with a basic definition.
Okay.
What exactly is a trading system?
At its core, a trading system is a set of predefined rules that are going to generate buy or sell signals.
Okay.
And the goal is to remove that emotional decision-making from the process.
Gotcha.
It's a way to bring discipline and consistency into your trading.
Right.
And while systems can range from simple to incredibly complex,
they
all share one crucial characteristic, which is they must be testable.
Testable meaning you can actually see if it holds up under real market conditions.
You need to be able to backtest a system against historical data to evaluate its performance and really just identify any potential weaknesses.
That makes sense, but I'm sure some people would say that intuition and experience are just as valuable, if not more so.
Intuition definitely has its place, especially as you gain experience.
Okay.
But I think the reality is that even the most seasoned traders can be swayed by emotions like fear and greed.
Right.
You know, a system provides a framework for objective decision-making.
Okay.
It helps you avoid those impulsive moves that can just derail your trading.
All right, I'm starting to see the appeal here.
Yeah.
So let's say someone wants to build their own trading system.
Okay.
Where do they even begin?
Well, trading systems lays out a really clear process that starts with observation.
Okay.
It's all about looking for patterns and relationships in market data.
Right.
Things like price movements, trading volume, and various technical indicators.
I imagine that can feel really overwhelming.
Yeah.
It's not like the market sends you a memo being like, hey, look at this.
Right. It's where the detective work comes in.
Yeah.
You might start by looking at historical charts and kind of identifying periods where the market showed consistent behavior.
Okay.
Or you could delve into economic data releases and see how certain assets react.
Gotcha.
It's about finding those potential clues.
Yeah.
That suggests there's some kind of predictable pattern there.
So it's like you're listening for those little whispers from the market being like, here's how I tend to behave.
Exactly. And once you've spotted a potential pattern, you can start formulating a hypothesis.
Okay.
Which is a testable rule that's based on your observations.
So is that kind of like saying, if the market does this, then it's likely to do that?
Yes. That's a good way to think about it.
Okay.
And that if-then statement is the foundation of your trading rule.
Okay, so let's say you have your hypothesis, you have your rule.
Right.
What's next?
Now comes the prediction phase.
Okay.
You need to articulate what should happen if your hypothesis is true.
Gotcha.
So for example, if you believe that a certain indicator reliably signals an upcoming price increase, then your prediction might be that the price will rise a certain percentage after that indicator is triggered.
So you're basically saying, if my rule is correct, then I should see this specific outcome.
Exactly. And once you have that prediction, you move on to the verification stage.
Okay.
And this is where you rigorously test your prediction using historical data to see if it actually holds up.
So you're back testing the system, seeing if it would have worked in the past.
Exactly.
But, I've heard people talk about the dangers of overfitting a system.
Yeah, that's a great point.
How does that come into play here?
That's a very common trap for new system developers.
Okay.
Overfitting happens when you create a system that's so specific to the past data that it fails to perform well in real-time trading. It's like making a key that fits one lock perfectly but can't open any others.
Okay.
Right.
So how do you avoid creating a system that's too tailored to the past?
One key principle is to keep it simple.
Okay.
The more complex your system, the more data it needs to support it.
Makes sense.
Trading systems talks about the concept of degrees of freedom, which essentially refers to the amount of information your system is using relative to the data that you're testing it on.
Degrees of freedom. That sounds a little technical.
Sure.
Could you break that down a bit further for our listener?
Think of it this way. Every rule or condition that you add to your system consumes a bit of information.
Okay.
If you have too many rules and not enough data to support them,
your
system becomes brittle and prone to overfitting.
Gotcha.
It's like trying to build a skyscraper on a foundation meant for a small house.
So it's like a balancing act between complexity and the amount of data that you have.
Exactly.
You're looking for a system that's robust enough to handle real-world market conditions.
Right.
But not so intricate that it just falls apart when things change.
Exactly. It's about finding that sweet spot where your system is complex enough to capture those nuances of the market, but not so complex that it becomes overly specific to the past.
Okay.
Right.
Gotcha.
It's one thing to talk about building a robust trading system in theory. But it's another to actually see it in action.
Totally. I'm always a fan of getting down to the nitty-gritty.
Right.
Do any of our sources kind of offer some real-world examples?
As a matter of fact, Trading Systems does a fantastic job of walking us through a case study.
Oh, cool.
Yeah, they dive into the development and evaluation of a trend-following system.
Okay.
Designed for the British pound-US dollar currency pair.
Okay.
And I think it's a great illustration of how these concepts we've been discussing can be applied in a real trading scenario.
All right, now we're talking, what kind of system did they build?
It's a classic trend-following system designed to identify and capitalize on trends in the currency market.
Okay.
And the system uses a combination of two moving averages to generate buy and sell signals.
Moving averages, those are like those lines on a chart that smooth out price fluctuations.
Right, by using a combination of a fast-moving average, which is more sensitive to recent price changes.
Gotcha.
And a slow-moving average, which gives you a broader picture of the trend.
Yeah.
They create a system that signals potential buy and sell opportunities.
So, if I'm understanding this correctly, when the fast-moving average crosses above the slow-moving average, that's a potential buy signal because it suggests that an upward trend is forming.
You got it.
Okay.
And conversely, when the fast-moving average crosses below the slow-moving average, that's a potential sell signal, indicating a possible downward trend.
That makes sense. But wouldn't you just buy or sell the moment those lines cross?
That's where things get a little more nuanced. To avoid jumping in on false signals, they actually use those crossover points to set entry orders.
Okay.
Not to immediately enter the market.
Gotcha.
So for a buy signal, they might place a buy order slightly above the high of the price bar where the crossover happened.
Oh, so they're waiting for a little extra confirmation that the trend is real.
Exactly. It's like getting a second opinion. Before making a big decision.
Right.
And for sell signals, they would use a similar approach.
Okay.
Placing a sell order slightly below the low of the crossover bar.
So it sounds like they're really emphasizing risk management here.
Absolutely.
Making sure they're entering trades with a higher probability of success.
Yeah.
Did they just randomly choose the lengths of those moving averages?
That's where it gets really interesting.
Okay.
They didn't just randomly choose.
Okay.
They tested a bunch of different combinations.
Oh, wow.
To see what worked best for this specific currency pair.
So it's like they were doing their own little science experiment.
You could say that.
To find the perfect formula.
They looked at factors like the overall profit.
Okay.
How much they could potentially lose, which is called drawdown.
Right.
And the number of trades the system generated.
Gotcha.
The goal was to find that balance between maximizing returns while also minimizing risk.
And did they hit the jackpot?
They found a combination that showed promising results.
Okay.
A fast-moving average of just 1 bar,
Okay.
which is essentially the current price.
Right.
And a slower-moving average of 44 bars.
Wow. A 1-bar moving average, that's like living on the edge.
Right. But it makes the system very responsive to even small price fluctuations.
Gotcha.
Pairing it with the slower-moving average smooths things out.
Right.
And helps to confirm the overall trend.
But the market is always changing.
Right.
Didn't they worry that those settings might become outdated?
That's where the concept of reoptimization comes in.
Okay.
They knew that they couldn't just set it and forget it. So they built in a regular reoptimization process.
Gotcha.
Meaning they would revisit those settings every few months.
Okay.
And adjust them based on the most recent market behavior.
So they were basically keeping their system up to date with the latest market trends.
That's a great analogy.
Like updating software to keep it running smoothly.
Exactly.
But to make sure those updates weren't just making the system look good on past data.
Right.
That overfitting problem that we talked about.
Yeah.
They used a technique called walk-forward analysis.
Exactly.
Remind me what walk-forward analysis is again.
It's a way of testing a system on data it hasn't seen before.
Okay.
To mimic real-time trading.
Gotcha.
Basically, you optimize your system on one chunk of historical data.
Okay.
Then test it on a completely new chunk.
Right.
And you keep moving forward through time.
So it's like a test drive on an unfamiliar road.
I like that.
To see how the system performs under pressure.
Right.
But okay, let's say we've got this optimized system.
Okay.
It's looking solid. How do they handle getting OUT of trades?
That's a great question.
It seems just as important as knowing when to enter.
You're absolutely right.
Yeah.
They realized they needed more than just those moving average crossovers to manage their trades once they were in.
Okay.
So they incorporated stops and targets.
Stops and targets. Help me out here.
Sure.
Refresh my memory. It's been a while since my trading 101 days.
So a stop-loss order is essentially a safety net.
Okay.
It automatically sells your position if the price drops below a certain point.
Gotcha.
Limiting your potential losses.
So you're cutting your losses short.
Right, before things get out of hand.
Gotcha.
And a profit target is your take the money and run point.
Okay.
It automatically sells your position when the price reaches a predetermined level of profit.
Right.
Locking in your gains before the market potentially turns against you.
So it's like setting a goal and sticking to it.
Exactly.
Not getting greedy and hoping for even bigger profits.
You got it. And they found that combining stops and targets really helped improve their system's risk-reward balance.
Okay.
They weren't just aiming for big wins.
Right.
They were also protecting themselves from big losses.
That's a smart move.
Yeah.
Did they use any other techniques to manage their trades?
They actually noticed that their system performed best during the London trading session.
Okay.
When things were typically more active and volatile.
Right.
So they implemented a time filter.
Okay.
Meaning they only allowed the system to generate signals during those specific hours.
So they were basically playing to the system's strengths.
Exactly.
Trading when it had the highest edge.
Right, but here's the thing.
Yeah.
Even with all of this meticulous work, they didn't just assume that their system would work flawlessly forever.
Right.
They wanted to understand how robust it truly was.
Makes sense.
So they used two more powerful techniques.
Okay.
Timescale analysis and Monte Carlo analysis.
Okay, you're going to have to explain this. They sound pretty intense.
Timescale analysis involves testing the system on different time frames.
Okay.
Like using 5-minute price charts,
right,
then 15-minute charts, and so on.
Gotcha.
This helps to determine if the system is effective across various levels of market activity.
Yeah.
Or if it's really only designed for a specific type of trading.
So it's like making sure your car can handle both city driving and highway cruising.
I like that.
Not just one or the other.
And then there's Monte Carlo analysis, which is where things get really interesting.
Monte Carlo analysis?
Yeah.
It sounds a little bit like something you'd hear in a casino.
Right.
Not in the world of trading.
You're not wrong.
Yeah.
The technique actually gets its name from the famous Monte Carlo casino.
Oh, wow.
In Monaco.
Okay.
And it's all about using random sampling to simulate thousands of potential market scenarios.
Okay.
It's kind of like running a bunch of what-if scenarios to see how your system would handle different conditions.
So it's like stress testing your system, putting it through the ringer to see how it holds up.
By simulating all these different possibilities, you can get a much better sense of the potential risks and rewards.
Okay.
Even those really unlikely events that might not show up in your backtesting.
I'm starting to see how this all ties together.
Yeah.
You're not just building a system to work in the past.
Right.
You're building a system to survive and thrive in the unpredictable future.
That's a great way to put it.
Yeah.
But okay, let's shift gears a bit.
Okay.
We've talked a lot about building and testing individual trading systems.
Right.
But what about putting them all together?
Yeah.
How do you go from a single system to a full-blown portfolio?
That's a question I've been wondering about.
Right.
I used to think portfolio building was all about picking assets that move in opposite directions.
Okay.
You know, like that classic advice to buy bonds when stocks are down.
Sure.
But I have a feeling it's more nuanced than that.
Yeah.
Especially in the world of systematic trading.
You're definitely on the right track.
Okay.
While diversifying across different asset classes, I is important.
Right.
It's not the whole story when it comes to building a portfolio of trading systems.
Okay.
The real key is understanding the correlation between the equity curves of your systems.
Okay, break that down for me.
Sure.
Equity curves, those are the lines on a chart that show how a system's profits or losses have grown over time.
Right. So when we talk about equity curve correlation, we're basically asking how similar are the shapes of those curves?
Okay.
If two systems have highly correlated equity curves, they tend to perform similarly, which isn't really ideal for diversification.
Because if one system hits a rough patch and starts losing money, the other one is likely to follow suit.
Precisely. That kind of defeats the purpose of spreading your risk.
Exactly.
What we really want are systems that zig when the others zag.
Right.
Systems with uncorrelated equity curves that perform differently in various market environments.
So it's not just about what you're trading.
Yeah.
It's about how your systems behave relative to each other.
That's a great way to put it.
Okay.
And trading systems actually challenges some of the conventional wisdom on this topic.
Oh, really?
They argue that relying solely on those traditional correlation measures between asset prices, like whether stocks and gold tend to move together or in opposite directions, can be misleading.
Because those relationships can change over time.
Exactly. What was uncorrelated yesterday might be highly correlated tomorrow.
Yeah.
The authors suggest that focusing on equity curves can give you a more dynamic and accurate picture of how your systems actually interact.
So it's like looking under the hood to see how the engine really works instead of just relying on the dashboard gauges.
I like that analogy.
So instead of just looking at whether, say, oil prices and the stock market have historically moved in the same direction, you'd be looking at how your oil trading system and your stock trading system have performed relative to each other.
That's the idea. You want to see if those equity curves are truly independent.
Right.
Meaning they don't consistently rise and fall together.
Okay.
That's how you build a portfolio that can weather different market storms.
This is making me rethink my whole approach to portfolio building.
Yeah.
But okay, let's say I've put in the work and I've got a collection of uncorrelated systems ready to go.
Okay.
Do I just let them all run at the same time?
Not necessarily.
Okay.
You can take a more dynamic approach.
All right.
By selectively activating and deactivating systems based on their real-time performance.
Gotcha.
Think of it like having a team of expert traders, each with their own strengths.
Okay.
You wouldn't necessarily want to put them all in the game at the same time.
Right.
You'd want to put your best performers on the field when their skills are most valuable.
I love that analogy.
Yeah.
So how do you decide which systems get to play at any given time?
Trading systems introduces a technique called the equity line crossover method, which basically helps you identify systems that are currently in an uptrend.
Gotcha.
So you basically calculate a moving average of a system's equity line.
Okay.
If the current equity line is above that moving average,
right,
it suggests that system is doing well and should be active.
Okay.
If it's below,
yeah,
it might be time to bench that system and wait for it to regain its momentum.
So it's like constantly evaluating your team and putting your top performers in the game.
Exactly.
While giving those who are struggling a chance to rest and regroup.
It's a way to stay agile and responsive to changing market conditions.
Right.
Always putting your best strategies forward.
This whole conversation has been a real eye-opener for me.
Yeah, it's fascinating stuff.
I'm starting to see that building a portfolio of trading systems isn't just about diversifying assets.
Right.
It's about diversifying strategies and managing them dynamically.
You got it. And it's a journey of continuous learning and adaptation.
Absolutely.
You're always looking for new ways to improve your systems and your overall approach. Yeah. But before we wrap up this deep dive, is there anything else from our exploration of these sources that you think our listeners should really take to heart?
One thing that really resonated with me was the emphasis on simplicity.
Absolutely.
It's so easy to get caught up in the idea that more complex systems are better.
Right.
But these authors really stress the importance of keeping things as straightforward as possible.
I completely agree. Simplicity often translates to robustness.
Yeah.
A simple system that's well understood and well tested is much more likely to hold up under pressure than a really complex system with a million moving parts.
It's a great reminder that sometimes the most elegant solutions are the simplest ones.
Absolutely.
Trying to outsmart the market with overly complex systems can really backfire.
And one last thought I'd like to leave our listener with is the importance of understanding the psychological side of trading.
Right.
It's not just about the numbers in the systems.
Yeah.
It's also about managing your own emotions.
Right.
And recognizing those moments when you might be letting fear or greed cloud your judgment.
So even with a systematic approach, you can't completely escape the human element of trading.
It's always there, lurking in the background.
Yeah.
But by being aware of your own biases and tendencies, you can use your system as a tool to make more rational and disciplined decisions.
That's a really powerful takeaway.
I think so.
Well, I think we've covered a lot of ground today.
We did.
From the basics of building a trading system to the complexities of portfolio construction.
Right.
I hope our listener is feeling inspired and ready to dive into the world of systematic trading.
I hope so, too.
Yeah.
It's a fascinating and challenging field. But for those who embrace the process of learning and adaptation, the potential rewards are significant.
And with that, we'll wrap up this deep dive into trading systems.
Great episode.
We encourage you to explore the source material yourself and continue your own journey of discovery. Absolutely.
Until next time, happy trading.